Hello, everyone, and welcome to your Onchain update for the 4th of August. I mean, it is just quiet. There's nothing happening. It really is quite remarkable to just see Bitcoin go to sleep like this. I saw some stats the other day that it's less volatile than the Nasdaq and the stock market. So, I mean, this is pretty wild, right? Bitcoin really has gone absolutely to sleep. There is just not much moving. We're seeing volatility levels that you really have to go back some distance to actually find. So we're going to try and assess what does this mean, right? And when you see these range compressions, they generally lead to some kind of expansion. I will admit that even though we've had those events play out, they've been really muted in 2023. Very interesting market structure. I'm not going to lie, I'm very surprised given the magnitude of what's going on in the world. We've got all sorts of stresses going on in the bond market. We're seeing US yields rising. We're seeing stuff going on in Japan, which is kind of the funding currency of a lot of these trades. Things are starting to happen. Now, how this plays out really is anybody's guess. The smartest investors in the world are also battling with what the hell is going on right now. So to see Bitcoin just kind of hovering and doing very little, I feel like it's more strength than not, but I'm also extremely conscious that something could blow up in the near term. And I think over the next couple of months, probably 6 months, we really have to be prepared for some serious volatility in both directions, even though the market's not giving us that right now. Just be really ready because the macro scenario is volatile, it is shifting, it is changing. It's not really in a great spot. Things are probably going to deteriorate, but we've also got this competing world where like the world deteriorates at the same time as it's looking very healthy. It's kind of all over the shop. So really just be prepared for all scenarios, I think is the right way to go. So what we're going to look at today is some of these volatility indicators, just a bit of a snapshot so you can kind of get a feel for it and just see just how quiet things actually are. We're going to move across to the derivative markets, which to be honest are more or less telling us the same thing, remarkably unlevered. Kind of ironic considering the traditional finance system is basically just one big ball of leverage right now. So almost the perfect counterbalance. And then we're going to spend some time looking at some short-term market indicators and just trying to get a bit of a read on direction, whether there's any kind of negative divergences, just stuff to just be aware of and help us kind of frame a bit of direction from here on. Okay, so starting off with just some price action technical tools. I do like to just contextualize these things, particularly when it goes quiet. Volatility doesn't need to be on chain. We can still use the whole suite of tools. You can still see that our drawdowns in this uptrend are insignificant. Now, this is a bullish sign in my view. This looks like the market simply just doesn't want to give anything back. It's not giving people an opportunity to get into their position. I find this particular chart quite constructive, even though the world, and I'm mentally prepared and financially prepared in case we get some kind of absolute chaos. This chart is remarkable. And it just will not give back the gains it's gotten. Granted, we haven't exactly punched through that 30,000 level the way that we would have liked to. But then again, there's also a lot of resistance at that point. That's kind of the last point of resistance until we get into what I'm going to call price discovery. I know price has been there before, but to be honest, getting above that 30,000 level would be remarkably strong in my view. Some of our big technical pricing models, they all sit below us. So it's not like we don't have a fair amount of support underneath us. Now, in terms of setting yourself some negative biases, right, if we do kind of break some levels, getting below the 200-day moving average at 26.7 would not be ideal. Getting down to it, very healthy. Not mad at getting down to the 200-day. What I want to do is find support just the same way that we did back here in March. As you can see, we're kind of climbing up the ranks. We're getting higher and higher in terms of the moving averages we're finding support on. But a 200-day, 26.7, a retest I'm okay with. Breaking and holding below, particularly on a weekly basis, not great. That would be my kind of conditional setup for all of this. But again, I really feel like this is a very controlled and structured downtrend. It does surprise me. And the other thing, sometimes you just look for these just general patterns. We had a real waterfall sell-off back here, right? Then we had a much less waterfall, and now we're basically trading sideways. This feels like a big dump, a miniature dump, and then a even less of a dump. It starts to feel like momentum to the upside, but we're going to counterbalance this because you'll see there's actually a little bit of momentum to the downside in some of the indicators we'll look at towards the end of this session. So anyway, we have plenty of support below us. And there kind of gives us some levels to just be conscious of. That 26.7 certainly stands out. But again, we've got a lot of support there, and a lot of these are models that lots of people look at, which is why we look at them, right? You generally want to look for things that are going to have a reaction because there's a lot of people staring at it. And when a lot of people are staring at it, you tend to get a reaction, self-fulfilling prophecy. On the Bollinger Bands, we are starting to squeeze in. You can see that we're getting our compression of volatility starting to come in. We really didn't get very much of an expansion following that previous squeeze. So we are in a very compressed range. And as you can see, these squeezes tend to result in some kind of volatility. This is just the nature of the beast. This is how markets tend to work. I won't spend too much time on these. Don't particularly give me too much. Here's the ones I want to look at. So there's lots of measures for volatility. There's obviously the actual volatility realized. I like to use these ones here as well. It's all based on the same principles, but compare the difference between the 7-day price, high and low. Basically, how much in a percentage are we trading within over the last week? And you can see we are down at very low levels, 3.6%. I mean, how often does Bitcoin trade at 3.6%? Well, the answer is not very often, right? Before the 2018 sell-off, we got to this level. Before the bull market in 2020, we got to this level. Following FTX and before 2023 kicked off, we reached these levels. Very, very quiet. You can also see this is a pretty low body. There's heaps of body up here, right? Bull markets and bear markets are pretty volatile periods. Very quiet in 2023. A couple of bursts here and there, but that's about it. It's been very quiet and controlled. On a 30-day basis, we basically have an even bigger picture of this, right? This is the lowest level. In 30 days, we traded between 9.7%. Again, back here in 2020, right before the sell-off, the 50% sell-off we had in 2018. These are very, very low numbers. They generally precede some kind of serious volatility. And as you can see, it can go in both directions. So it's about just putting that crash helmet on and being prepared for both outcomes at this point. And our realized volatility, this is looking at all different time series, right? From everything from 1 week, 1 month, 2 years, 6 months. On our short term, right? 1 month and 1 week, we're down at 23%. Again, back here in before the bull run, right before the sell-off, very, very rarely do we get these low levels of volatility. And even the long term are starting to pull down, right? Bitcoin historically has been like, oh, it's an 80 vol asset. But at the moment, it's, on a 1 year basis, talking about 49%, 6 month, 47%. So we're talking about almost a halving of the annualized volatility. This is pretty remarkable, right? We are seeing Bitcoin really quieten down. Now, I don't know whether this is the calm before the storm. I truly don't, because it's a really tough market to read. But it is certainly something that tells me that there is a move coming, right? There is a true move coming, and we just need to be prepared and conscious. Alrighty, let's move across and have a quick look at some derivative markets. I'm going to focus on perpetual swaps because they are essentially where most of the trade volume happens. And then we'll shift across and look at options markets, which is where a lot of the action is actually happening right now. Now, we can see that overall, this is in USD open interest. It's kind of climbing alongside price. Generally speaking, that tells me that it's probably not building up in overall leverage. Bitcoin's got a little bit of a stronger uptrend than Ethereum. Ethereum is actually quite flat on the right-hand side here. And we then can kind of verify that by looking at it in terms of BTC or ETH terms. ETH is actually seeing a reduction in overall open interest. We are still seeing that Bitcoin is where a lot of the trade volume and the open interest is happening. We are still seeing that capital rotation higher and higher up the stack. This appears to still be in play. So just one to be aware of and conscious of. I think it's an interesting observation, albeit very, very slight, right? This is not kind of a macro market is leaving ETH, but it's certainly not getting excited about ETH either, just in terms of a relative performance. If we look at it in terms of a dominance perspective, we can see we've now got a fairly sustained uptrend in Bitcoin dominance. 66% of all open interest is now denominated in BTC contracts, and Ethereum is actually seeing a reduction over time, right? 34%. Things are starting to move back towards that Bitcoin dominance. Again, capital just moves up and up when risk is in play. And to be honest, this is probably a bit more of a bearish signal than a bullish signal, because it's telling us the market is a bit risk off. It's not willing to go out in the risk curve. And from that lens, and there's many metrics here. I'm not constructive on altcoins at this point in time. I really do think that it's not. I don't think the market's going to take kindly to the long tail of risk for some time. To be honest, I'm probably talking 6 to 12 months. is kind of my gut feel. And if you go back and study 2019, 2020, you will see that altcoins really didn't perform until Bitcoin had kind of cracked its previous all-time high. And my gut feel is we're probably 12, 18 months away from that event as well. So anyway, I just don't particularly see a strong risk appetite in the market for now. Feeding onto that point, look at trade volume. I mean, talk about low volatility, it is falling off a cliff. Ethereum trade volume, you have to literally go back to the start of the bull run when we barely even had derivatives to find this low trade volume. Unbelievably low. Same for Bitcoin. Just the only time was during the Christmas lull. You've got to go back to before the bull market in 2020. Quiet stuff. Pretty wild. Volume dominance, again, we've now got a fairly sustained uptrend for Bitcoin, now at 70%, 69% dominance. Liquidations, that's probably not overly relevant, and we'll touch on the rest of it in a second. Now, options markets. We have seen options explode onto the scene for Bitcoin, actually. So trade volumes remain relatively high, particularly around volatile periods, which is when there's volatility premium. It's when people are closing and opening options at a higher rate. This is just how these kind of markets tend to work. We have seen a general uptick in options open interest, but it is starting to decline a little bit. Again, speaking to that reduction in volatility, and so is trade volume. It is, I mean, naturally at highest trade volume during volatile periods and a pretty low reduction over time. It is elevated relative to 2021, 22. I believe this is a healthier form of leverage to see people in options. I think it's a more controlled, it's a more advanced, it's more sophisticated actors. It is more elevated. There's a lot more going on, and thus we just have to pay a little bit more attention. But really, there's nothing here that's kind of, showing me that something's kind of wild and out of sync. The implied volatility is also, this is unbelievably low. 31%, 32% in terms of implied volatility. You can see, this, just for those who aren't familiar with options, the implied volatility is basically how much the market is pricing in the probability of hitting a strike price. So let's imagine that Bitcoin's at 30,000. If your strike is at 35,000, right, in 1 month's time, you need a fair amount of volatility to get up that $5,000 to hit your target. Now, if your target was if your strike price was $100,000 in that same 1 month window, your volatility has to be so much larger to go from 30 to 100 in a month. So the more out of the money an option is, the more volatility is required to get there. So what options are doing is trying to price in what is the expected volatility in those options. Now, generally speaking, when you have low volatility, quiet markets, the market's not pricing in forward expectations of high volatility, what actually happens is that basically means that options are cheap. So people are more likely, or the smart money, will be buying options with a low volatility premium because when the market starts to move, that premium spikes higher. And then they can essentially sell their options into that spike. So people can basically buy both a put and a call. They don't particularly care which direction the market goes, just make it volatile. So if the market rips higher, their call goes shooting into the money, their put loses money, but they don't care because their call option got just absolutely minted. And vice versa. If it sells off, they make money on the put. They don't care about the loss on the call. That's the cost of doing business. So that is essentially what we're seeing here. Extremely low levels. You're pretty much all-time lows, right? You got to go back. So the market's just not expecting high volatility, which means that when it happens, it's probably going to be pretty damn violent. Okay, so the last thing that I want to touch on is some short-term on-chain indicators. Try to get a bit of direction. So at the moment, really, the biggest takeaway is that there's not much moving. The market is pricing in a very low degree of volatility, and thus we want to start finding: is there any indication of directionality? Are there any divergences we can pay attention to? How do we try and get a feel for which way this thing may break? Now, what we can see here is we're looking at our on-chain cost basis. So as I said, we've got many technical indicators. We also have the short-term holder at 28.3. Now, the important thing about that is that if we break below that, there's a bunch of people who are going to be trapped, and they're going to have basically coins held at a loss. So breaking below the short-term holder cost basis would be something to pay attention to, because it may signify that we're actually going to get a bit of a cascade, right? I don't believe it's going to be a market nuking, but it would probably put us into a correction, maybe get us down to that 200-day, and then we can come back and reassess as those metrics play out. Maybe we get a nice realized loss, a nice top buyer flush, and then a beautiful bounce. That's kind of expected behavior, but that's kind of the level. If we get down into the low 28,000s, we should find support. If not, we may well get down to that next level. The probabilities increase, we get down to the 200-day. The rate of change, you'll see this actually across several of these metrics. This is kind of it's not a bearish divergence, but we're approaching the point of seller exhaustion. So this is looking at the rate of change of the various cost bases, the short-term holder in red being the most relevant. When this starts to decay, it basically means that coins are no longer being repriced. They're not being repriced higher, they're not being repriced lower. The market's tired, it wants to move, it needs to go somewhere before something happens. That's kind of the status that we're in. And again, it kind of speaks to that volatility. It doesn't really give us too much direction, but the assumption should be that we want to head higher given the kind of local market structure. But again, that remains to be seen. On the MVRV, which is basically the same thing, right? We're tracking the distance between price and the short-term holder cost basis. You can see here that we are testing that lower level. Now, one thing to note here is note that we have a higher high. We've been at 30, 31K twice, right? Back here in March, and then again here in June, July, August. Now, we have a lower high on the MVRV. What does that mean? That means of all the coins in the last 155 days, which is pretty much that zone, our entire topping zone, there is less profit in the system than there was back in March and April and May. So the takeaway from that is we have a more locally top-heavy market. We don't have what I would call a top-heavy market, which is like, oh shit, if we go below this, it's cascade, right? That's November 2021 style. This is just telling us that we have a bearish divergence. It's not the most negative thing. It's not a uptrend breaking thing, but it is a correction creating thing, if that makes sense. Over the short term, it gives a little bit more weight towards we may have a deeper correction. That's just the way I'm thinking about this. I don't believe it's going to be trend breaking, but I do think it could be correction forming, if that makes sense. Same on their profit and loss. You can see there's a slight bearish divergence across here, the degree of profit and loss that's coming in. This here is really telling me that we're again at that exhaustion point. The market wants to do something. You can see that this is kind of bull market behavior where we spend our time above the neutral level of 1. The expected behavior is a bounce. And what I'm really looking for is things that may invalidate that thesis and tell us that we may be heading into a deeper correction. Perhaps this uptrend does in fact fail, right? That has to be a possibility that we really do keep in the back of our minds. We don't have evidence for that yet. We just have a slight softening. But again, a single rally and all of this kind of softening can just immediately disappear, right? The market is fickle. It just kind of needs to find its new direction. And to be honest, a lot of this is kind of expected behavior. It's going to take time to get through 30K to my view. SOPA indicators have just decayed to nothing. Very, very little going on. You can see just the scale of this, right? Early 2023, we had a whole lot of activity, lots of profit, lots of loss, beautiful textbook. It's just gone dead quiet. It is unreal. Quite something to see. Very, very low volatility across all of our SOPA metrics. Low volatility, funding rates 7.2% actually. So on net, people are net more long, even though we're not looking like futures markets don't have a huge deal of leverage in them. 7.2% is non-trivial, and it is ticking a little bit higher. So I mean, I'm not going to take too much signal from this, given how low the kind of general leverage is. It's certainly nothing like full bull. So I don't believe there's any kind of major cascade here, but people are net bullish. So therefore, a correction may kind of flush that out. But again, we'll kind of have to wait and see how this plays out. Now, the last one that I want to touch on, this is a really cool metric. So this is looking at short-term holders, and we have two different cost bases models. The one in blue is their held supply cost basis, right? The coins that they hold. What is the short-term holder cost basis? We looked at it before. The green one, now this is a really interesting concept. The green one is the cost basis of their spending. So this is coming from SOPA. We've got MVRV, which gives us the unrealized profit and loss. And then we've got SOPA, which gives us the realized, the spent profit and loss. Now, when they're spending coins at a lower cost basis than their cost basis, that speaks to panic, fear. People who bought down here are getting out, get me out, get me out. That's much more bearish. Conversely, during an uptrend, you want them spending, like, the guys at the top, right? You want coins churning around and people are taking profits and the market's got demand to absorb it. This is all good stuff. Now, this metric gives us a couple of things. First one, look at this absolutely beautiful bearish divergence, right? We're getting a weakening of trend. Guys start spending coins closer and closer to their actual cost basis. And the crossover is when you go, okay, we have a trend shift. Now, this comes typically late, right? The sell-off has kind of already happened, but we do have this kind of decaying curve. We had it the same here in 2021 at the top. We have a bearish divergence again, right? So basically the market's being capped in terms of price with less and less spending going on, right? Spending is going to be a bit more close to their actual cost basis. There's just not as much momentum. Momentum is a really important word here. Doesn't mean that the uptrend is dead and buried, but it means it's certainly weakening, and we need to just start preparing and just being conscious that that may play out. So speaking of momentum, these are these kind of super reflexive models. Long-term and short-term is what we're going to look at. The first one on the long-term holders, we are still in an uptrend. You can see that these typically stick the landing for a long time. They're also very late to the party when things blow off. Not too late, but still later. Nothing really showing up here. At the moment, it kind of just looks like, we still have positive momentum. Short-term holders, on the other hand, we're starting to get a bit of curling over. This has not crossed over yet. A crossover is usually a very good early signal, right, that we may have some weakness. But again, here's that bearish divergence. So again, it's not the end of the world, but it's certainly telling us just keep your ears pricked, because things don't quite have the same level of oomph that they previously had. So what I'm looking for, we've got a profit decline, but the real signal is that we get losses pick up. If losses really start to pick up, which naturally will happen if we get below the short-term holder cost basis around that 28.3 level, then you start talking about, okay, maybe we've got some downside here. The 200 days, then they're at 26.7. That really needs to hold as support. And that now we've at least got a framework, right? So critical mass is in that kind of low 28,000s. And then really support that we want to see hold is in that 26.7. If both of those levels get taken out, now we start talking about maybe we do in fact have a deeper correction on our hands. Obviously, we're going to be down about 3K from there. So we've kind of got a bit of a framework in terms of risk. And obviously upside, everyone's happy, and we enjoy the ride. So anyway, hopefully that's a useful assessment. Really hard to read this market at the moment. The world's in a very strange place. So just be prepared for both, be prepared for all, and have a great weekend. To be honest, when the market's this quiet, sometimes it's nice to just go to the beach. So have a good one, and I'll see you in the next. Cheers.